All eyes were on this particular week's economic news, and this week was Jobs Week. So two jobs data came out, both the ADP and the BLS. Now first we'll start by summarizing exactly what happened on the ADP report. February ADP Employment report indicates that 140,000 jobs were created. And that was actually slightly below expectations, which remember when it comes to mortgage rates, the worse the jobs report comes back, the better it is for rates. So overall, the ADP report was not necessarily extremely market moving. The rates actually reacted quite favorably to this news because again, it was lower than the expectations that they were anticipating for this particular month. And of course, the second highly anticipated report was the BLS jobs report. Now, the jobs creation number that came out for the month of February ended up being 275,000 jobs created, which actually did surpass the market expectations of 200,000. However, this actually didn't have a very negative impact on mortgage rates at all. In fact, they actually remain relatively flat. And the reason why is actually because of the significant downward revisions that the BLS jobs report announced to the January figures. I've talked about this in the previous video before, but the January jobs report was completely insane. The headline numbers stated that 353,000 jobs were created when the markets were only expecting about 160,000. That significantly impacted pretty much every asset class you can imagine, and rates corrected up due to that reporting. In addition to the February numbers, they announced that they're going to do downward revisions to January numbers by about 167,000 jobs. So down from the headline 353,000 all the way to 229,000. That's huge. But thankfully, because of that downward revision, despite the fact that the job creations for the BLS still surpassed the market expectations, yeah, the bond market didn't really care. It kind of negated each other out, but it's still nonetheless very frustrating that if this were announced originally on the actual original headline, we may not have seen the rates creep up to where they got to. Now, aside from the jobs reports, our boy, Jerome Powell, he was actually going to be speaking to both Congress and the Senate this particular week, and the markets are always watching out for any new commentary that they might add. Now, the testimony to Congress was nothing new. All the typical kind of skittish talk of, oh, we want inflation to be a little bit closer to our target. The labor market remains very tight, so we're just gonna see how everything goes. But the testimony to the Senate is when things got a little bit more interesting because he actually added an additional comment that we haven't heard before. He actually stated during the Q&A session that he is not far from gaining the confidence needed to start easing into the cycle of rate cuts. And keep in mind, for the past month, he's been backtracking a lot of what he mentioned before about how he's open to cutting rates already. He's, wait, no, not ready yet. But now he's changing his tone again, and the bond markets react extremely favorably to that news. So long story short, the good news is this week we are actually down in terms of the average 30-year fixed rates. We've been elevated over that 7% threshold since that jobs report came out in January, and of course the inflated inflation reports that followed it. But now we're back down under 7%, and we're ending the week at 6.85% for the national industry-wide average.